Advanced Financial Modeling, Topic 6, Forwards and Futures, Learning Objective number 2. We're going to compute theoretical forward prices for equities, currencies, and commodities. So let's talk about forward prices for a minute. So what do we mean by forward prices? If you go to the market, whatever you want to call the market, or a bank or some other institution, and try to figure out what price can I buy or sell, say, cocoa beans 1 year from now, what we're talking about are the forward prices, the prices to buy or sell an asset at a future date and time. Now, it can be difficult to obtain forward market prices because forward contract terms like asset quality, quantity, and delivery dates are negotiated between counterparties. Exchange traded futures prices provide a nice benchmark for assets, their quantities and delivery dates. For example, the Chicago Mercantile Exchange oil contract is for 1,000 gallons of Brent crude. Or you can say that also the Chicago Mercantile Exchange cocoa contracts are based on 10 metric tons of beans of a certain quality. So in other words, they'll specify what percentage of mold could be in the beans, what percentage of foreign matter, etc. So you know exactly what you're buying. Now, forward and futures contracts are also benchmarked against the current spot price. When I say spot price, that's today's price to buy or sell for near immediate delivery. It's also called the cash price. So you can think of the spot price and cash price as the price you pay today. So the spot price and forward prices are often benchmarked. So for example, you might calculate or graph what we call a forward or a futures curve, where you just put in the current spot price of the asset for delivery today, period 0. And then you could graph, say, for 1 year delivery, 2 year delivery, 3 year delivery, and so on. If the prices are going up, meaning that the forward prices or futures prices for future deliveries are above the spot, we say the forward market is in contango. Not my term, so don't blame me. If the forward or futures prices for future delivery dates are below the current spot price, we say the market is in backwardation. So that's when forward prices are less than spot. So if the forward curve is upward sloping, prices are getting higher for future dates, contango. If it's downward sloping, it's getting cheaper for future dates. It's in backwardation. However, we have to think about there's an evolution of prices in the marketplace. Say currently you enter into a forward contract on oil, and the current spot price is this price right here, and the futures price, and so we'll say this is the spot price today for the underlying asset, and the futures price for, say, 1 year delivery is right here. So it's what we can do is we can graph this. And this would be the basis. This would be the forward spot basis, the difference between the forward price and the spot price. However, if this is, say, a 1 year contract, and this is 1 year from now, the spot price will evolve, but also the futures price could evolve. So the futures price is changing on a daily basis in contracts, and the underlying spot prices are evolving. However, at maturity, these prices have to come together. At maturity, the forward or futures price and the spot price have to converge. And you can think about it very, very easily. If this contract today is for 1 year delivery, and that's the basis, that's the difference between 1 year delivery price and today, and say 6 months from now, that futures contract is now a 6-month futures contract, now not a 1 year contract. Well, 364 days from now, it's now a 1 day forward or futures contract. So you can't imagine there could be much of a difference in price between delivery tomorrow, using a 1 year forward or futures price, and delivery today in the spot markets. Otherwise, there'd be arbitrage. And on maturity date, they have to be the exact same price. Because otherwise, I'd just enter into a forward contract to buy, if the forward contract, say, expires later today, I would enter into a forward contract if that price was cheaper than the spot price. And if it's the other way around, the futures price is below the current spot price, the market is in backwardation. And eventually, at maturity of the contract, they have to converge to the same price. So at maturity, the spot price, we'll say the spot price at maturity has to be equal to the futures or spot price at maturity. Before maturity, they could be lower or higher, but at maturity, they converge. The forward or futures price converges to the spot price. So let's talk about how to calculate the forward or a fair forward price or futures price for an individual stock. To do that, it's helpful to think about something that we're going to talk about, a cash and carry arbitrage. I'm going to walk you through how to create a cash and carry arbitrage on an individual stock or stock portfolio, and then show you that could determine what a fair futures price is, price for a future delivery date. So here's what a cash and carry arbitrage is. It's a risk-free strategy to buy an asset today and simultaneously enter into a forward contract to sell it later. So I could enter into a contract today to say buy the S&P 500 1 year from now. Okay. However, you simultaneously, let's change that around. Today you would buy the asset today, buy the S&P 500 today, and simultaneously enter into a forward contract to sell it in 1 year. So think about your position then. Today I bought the S&P 500, and now I have a contract to sell the S&P 500 1 year from now. All right. Or you can do this for an individual stock. Say for Tesla stock, I could buy a share of Tesla today and enter into a contract to sell a share of Tesla 1 year from now. And Tesla is actually a good example because it doesn't pay a dividend. So if a stock doesn't pay a dividend, it's a little bit easier what we're going to work through. So here are the steps into doing this cash and carry arbitrage. Buy the non-dividend paying stock today in the spot market or cash market, and you'll pay S0. That's the spot price today for that underlying stock, say Tesla. Then you enter into a forward contract to sell Tesla in, say, T years. We'll call that F0T. It's the forward or futures price today for delivery at time T. Then, for this to be an arbitrage, you don't use any of your own money. You will finance the purchase of today's stock at some interest rate R for T years. All right, so you now own the asset, you have a loan on the asset at interest rate R, and you have a forward contract to sell the asset, say, T years from now. Here's your risk-free profit. You know you're going to sell it next year at F0T. You already bought it at S0, and you're going to pay R interest. So the profit of that cash and carry arbitrage is you're going to receive the forward price at maturity, and you're going to pay off your loan, which is today's spot price plus interest. So if the markets are efficient in that these arbitrage situations don't exist, these two numbers have to be the same. Otherwise, there'd be incentives to do this kind of contract all the time. So we say that the no arbitrage, or the cool kids say no arb, forward price is simply equal to today's spot price plus 1 plus the interest rate. How we describe that is that the forward price is simply related to two things: the current spot price and the price to finance the position. That's all it determines. So forward prices and futures prices have nothing to do with the speculation whether the stock's going to go up or down on Tesla. Because in this situation, you don't care if the stock price goes up or down because you've already bought it and you already have the price to sell it. The only thing that matters is the interest rate that you're going to be charged. So what we say is that the forward price is determined by today's spot price plus the cost to finance the position, but we call that the cost to carry. The cost of carrying this position is the interest rate. All right, now for a dividend-paying stock or an index portfolio, say you want to do a cash and carry arbitrage with the S&P 500. You would buy the S&P 500 today, finance it at rate R. However, the S&P 500 has a dividend yield, say 2%. So while you're holding that portfolio, you're paying R, but you're receiving the dividends. And so the dividends are, in some sense, reducing your cost of carrying the position. So this is the no arbitrage price for a dividend-paying stock or stock portfolio. It's 1 plus the interest rate minus the dividend yield. And by the way, that interest rate will consider the risk-free rate, because in theory, you could borrow at the risk-free rate since you've entered into a contract that has no risk. Remember, you're buying the asset and simultaneously have a contract to sell it. So the cost of carry for a dividend payer is R minus D, And if interest rates are greater than dividend yields, that means the market's in contango, meaning the forward prices are above spot prices. If R is less than D, that means the market is in backwardation. Spot prices of the future of, say, the S&P 500 could be below the current spot price if the dividend yield is greater than interest rates, which it was for much of the last decade when interest rates were very low. All right, so let's do an example. I gathered some data, and we're just going to calculate the no-arb forward price for the S&P 500. So I gathered some prices also of the S&P 500 forward prices or futures prices at the CME, Chicago Mercantile Exchange, and we'll just compare them to see if they're even close. So I gathered some data here on May 22nd of 2024. The spot price of the S&P 500 was 53.17, had a 1.34% dividend yield, and there was forward prices for 7-month, 10-month, and 12-month deliveries. The 7-month Treasury rate, risk-free rate, was about 4.60 annualized. The 10-month was 5%. The 12-month was about 5.14. And as far as T, 7 months is 0.58 years, 10 months is 0.83 years, and 12 months is 1 year. So we'll go ahead and go to the spreadsheet, and we'll go ahead and calculate those no-arb forward prices. So I said the no-arb forward price is the spot price, anchor it, times 1 plus the interest rate, that's the cost of financing the position, minus the dividend yield, anchor the dividend yield, raise it to the power of T. So today's spot price of the S&P was 5,300 on May 22nd. That 7-month forward price should be 54.13, which is 1.9% above the spot. And then the 7-month and 1-year contracts, I'll just copy, should be at these levels. Again, forward price being above the spot because R is greater than D. So again, big insight. Forward and futures prices have nothing to do with speculation of an individual stock or a portfolio. It's simply the cost of carry. And if I compare that to what was actually going on in the market, I was forecasting 54.18. It was selling for 54.65. I estimated 54.79. And so you can see they're kind of close, but not exactly. And that may reflect the different interest rates available for people to borrow. And also different estimates of what dividend yields are. Again, dividend yields are only estimates. And based on the timing of when dividends get paid, they could change for different periods. So that's why I imagine they're a little different. Let's think about a cash and carry arbitrage for a commodity, and then we can come up with a no-arb forward price or futures price for a commodity. Now, the cost of carrying a commodity such as oil, gold, hogs, cocoa include more than just the borrowing cost. You actually need to store the asset. We'll call it S. S is the percentage of the spot price that you'd spend annually to store the asset. Say, store gold or put cocoa in a silo or put gold in a bank. So you have that extra cost, S, the storage cost. However, commodities, you have a possible lease income. All right, so we'll talk about lease income in a second. So sometimes if you buy an asset today, you could lease it out to somebody. Also, so that's going to be kind of like a dividend. And also you could, there are some other tangible or benefits for having tangible ownership of an asset, having possession of an asset. Maybe you're Hershey Foods, and you're not perfectly indifferent between having a forward contract to buy cocoa versus owning it today, because if I own it today and demand spikes, I have some, I could just take it out of the silos. There's some benefit of having a possession. So the no-arb forward price for a commodity. Today's spot price times 1 plus the interest rate. All right, just like stocks. Plus storage costs. So if it costs me money to store the grain in a silo, or I have to rent out some silos or whatever that is, minus any kind of lease rate on that asset. So it's kind of like a dividend yield for a commodity. So why would I be able to lease out a commodity? Well, I want to talk about that in a minute. And then lastly, I subtract any other benefit from owning the asset, we'll call it C. So my cost of carrying a commodity is the interest rate plus storage minus lease minus convenience. So let's do an example of a live cow cost of carry. I'm going to buy a cow today and enter into a forward contract to sell it in, say, 6 months. I'm going to borrow at some interest rate R. Okay, that's what the R is. I'm then going to pay somebody to hold the cow for me and pay it. We'll call that S as a percentage of the asset. Then maybe I could lease the cow to a dairy for the milk. You can think about the milk being little dividend payments being squirted out. So that's going to be my lease payment. And then I can also compute that there's some convenience yield. I kind of like having the cows around or something like that, or maybe I can get the access to them earlier than the forward contract might specify. So that would be it. Let's talk about cost of carry for gold. I would finance purchase of gold today at some R. We generally say gold has no storage costs because it could be held in certificate form, free of charge. There are lease payments for gold. Now, who would pay you to lease your gold? Well, that's why I have a question mark here. What are short sales? In other courses, you may learn that a short sale is just a sale of an asset before you actually buy it. You sell it first and then buy it. So the question is, well, where did you get it? If you want to short sell gold, you need to borrow it from somebody, sell it, and then buy it back. Well, when you borrow it from somebody, they're not going to give it to you for free. They're going to lease it to you. So that the lease rate on gold is actually what's being paid by the short sellers. And then for gold, we'll just say there's no convenience yield. There's no benefit to having physical holding of it, especially if it's held in certificate form. You can't stare at a nice shiny piece of gold. So let's go ahead and do a calculation for gold. I'm going to go to the spreadsheet. I have gold here. On this date, gold was selling for $2,400 an ounce. The 1-year treasury was 5.14. I Googled and the lease rate for gold was 0.9%. We'll assume no storage cost, no convenience yield, but I'll leave it in the formula. So the no arb forward price for gold is 2,400 times 1 plus the cost of carry, R plus storage minus lease minus convenience raised to the T power. And so that number is 2,506. So in theory, the gold should be selling for $2,500 in forward markets. But on that date, it was actually selling for $2,400, so it didn't do that well. I'm not sure why. All right, so that's how you calculate the cost of carry and the no arb forward prices for gold and other commodities. The last one we want to cover is currencies. One of the major markets in the world are currencies, both in the spot market and in the forward market. So if I know I need, say, euros next year to pay a vendor off in Germany, I could buy the euros today, or I can enter into a forward contract to buy them, say, a year from now. So we're on the same concept. What is the cost of carrying a euro versus, say, a stock versus, say, other commodities? Well, what if I enter into a forward contract to buy 1 euro? At some price, we'll call it S0, dollar per euro. So there's some spot price today, and you buy 1 euro today. So you buy it and you finance it at some rate R plus dollar. All right, I'm sorry, 1 plus R, and that's the US risk-free rate. So you finance your purchase of the euro at R dollar. Since you're an American, you're buying the euros and financing it with dollars. All right. Now, since you're holding onto a euro, you're not just going to put the euro in a drawer or put it under your desk or something. You're going to invest the euro. Where would you put it? I'd probably just put it in a German bank and earn whatever the European interest rate is, say the sovereign German Bund rate, which is their treasury. So while you're holding it, you're going to get the foreign interest rate. So for euros, if I buy the euro today and enter into a contract to sell the euro a year from now, and while I'm holding the euro, I'm investing in a euro bond, euro-denominated bond. What we say is that forward price, that no arbitrage forward price, is today's spot times 1 plus the interest rate. That's the cost to carry, but that's being offset by dividing by 1 plus the euro interest rate, and that's going to reduce the cost to carry. All right, so that's it. That is the no arbitrage price for the euro. Now, that formula only works for what we call direct quote currencies, those that are quoted in dollars, which are generally the euro, the pound, and a few others. However, if it's an indirect quote, say the yen, which is quoted as yen per dollar, then we say the no arbitrage forward price in yen per dollar is today's yen per dollar exchange rate over 1 plus the yen rate over 1 plus the US rate. So be careful when you're applying this formula. If it's a dollar price is quoted as a dollar price quoting of the foreign currency, like the dollar price of the euro, you multiply times 1 plus the dollar rate over 1 plus the foreign rate. If it's a FX price of $1, then it's 1 plus the foreign rate over 1 plus the US interest rate. And we'll just go ahead and take a look at this for the Australian dollar, and say that US interest rates are 5.14, Australian interest rates are 4.27 on this day. The spot price, dollar price of an Aussie was 66.39. There was the forward price, but what was the no arbitrage forward price? It's the spot price times 1 plus the US interest rate divided by 1 plus the Aussie interest rate. And you can see it's almost the exact same calculation. And in this case, the cost to carry is pretty close, right? Because if I'm buying a euro, I'm going to borrow at 5%, but invest at 4.27. And so that's why, in this case, the forward price is slightly above the spot price because the cost to carry is positive. I'm borrowing at 5%. I'm investing those Aussies at 4.27. So that's how we calculate the no arbitrage forward prices on currencies. So summary, the forward price must be equal to the cost of carrying the position, otherwise arbitrage is possible. Any asset that can be cheaply stored without spoilage can be priced using a no arbitrage argument. But this argument doesn't work for things like lettuce, right? Because you can't store lettuce for a year. And also things that are very expensive to store, like electricity. We don't have batteries good enough to store electricity without losing a lot of it. So if those assets are relatively easy to store, we say it's in the carry market. All that means is we're allowed to use our formula that uses the cost of carry. So we say that stocks, bonds, currencies, gold, silver, oil, etc., are in the carry market. But things like lettuce, which doesn't exist, forward contracts, or electricity, in those cases, we say it's not in the carry market. We can't use that formula because it's hard to carry the asset without much loss. And those assets, like electricity, are too costly to store. Their forward prices simply reflect expected supply and demand. So it's basically speculation on future supply and demand. So that was a primer for how to calculate a theoretical forward and futures contract price. Those prices for those underlying assets. So it's common to have those numbers ready before you enter the market to figure out what is a fair price to pay for, say, 1 year delivery or take delivery of an asset.